Good evening, everyone. Welcome to the Under the Microscope edition of the US dollar core global growth note. I'm just going to wait for everyone to jump on the call, but we're going to run through the mechanics of it, and please feel free to ask questions as we go along, and I might answer them at the end. But the whole point of this webinar is to be interactive, and it's try and answer and unpack this product as much as possible. You should come away understanding exactly how the product works, exactly what the risks are, who should use it, and essentially exactly what it says on the tin, and even how it does what it does. If you don't understand anything, please stop me and ask. We've got quite a lot of information to go through, and I've been told I must keep it to 45 minutes with some Q&A at the end. So I'm going to try and run through it pretty quickly as well. So to get started, the note that we're talking about today is it's a note that's created by Rand Swiss, and I'm going to go through the structure and the underlying custodians and everything around the note in time. But essentially what this product does is it's a 5-year investment linked to a diversified basket of global equities. Now, how do we do that? We don't go and buy millions of little shares underneath it. What we do instead is we get exposure to the broad indices. So the indices that you're looking at here are the S&P 500. The S&P 500 typically has become a larger component of most indexes. If you're looking at something like the MSCI World or the MSCI, or at least the all country ETFs, etc. So we've upweighted that to 40%. Then there's 30% Nikkei, 30% Euro stocks. I'll go through some of the reasoning behind it, but both of them are looking pretty cheap at the moment. Important to understand that these are price indexes as well, so price indices. So with all of these notes, the one thing that you've got to bear in mind, I'm going to say right up front, is that you don't get dividends from the indices as you would if you were buying an ETF. But what you're going to do is track the underlying ETF price performance. So what is the return? But obviously, if the markets lift or even if the currencies weaken, so if, for example, there's a lot of fear around the yen at the moment, if the yen was to weaken and that was to boost the Nikkei higher, you're looking at the price of the Nikkei. And this again, another, I suppose it's not a trick, but I want to kind of unpack some of the tricks that people use with structured products. This is not a worst of index. This is a weighted basket of these stocks. So I'm going to go through some back testing with you as well, but bear in mind, this is a weighted basket, 40%, 30%, 30%. You're not exposed to, if the Nikkei collapses, yes, you've got a portion of Nikkei exposure, but many of these products are worst of baskets. This isn't a worst of basket. This is a weighted average basket. Okay, so then you look at what is the return on this. The return is what it says it does on the tin. And when it comes to these kind of growth notes, what it says on the tin is what it's going to do. The risk isn't that the contingent payoff isn't going to come out. The risks are elsewhere, but like I said, I'll go through those. The upside participation at the moment, and I've been pricing these today, so I've kind of pinged all the different issuers just to get a sense of exactly where the market is at the moment. We're actually sitting at about 210% participation as we're doing this, and I'll explain how the participation is calculated further in the presentation. But essentially, what does that 190% upside participation mean? It means if the market goes up 10%, if that weighted basket goes up 10%, you're going to go up 19%. So you get that gearing factor. At the same time, you have capital protection built into the product. So if that weighted basket starts to fall, and let's say it ends lower, you've got a 40% downside protection inside that basket. So that's what the return is going to be. There is an upside cap as well, and that upside cap is also at 40% up, but with the 1.9 times gearing, the 190% participation, what that means is that you essentially get to a 76% cap on your return of the product. I'm going to go through charts and all sorts of things, so don't worry if you haven't got that just now. Like I said, downside protection, and then of course a minimum investment of around $20,000 US. This is a fully offshore note, so we are buying in dollars. I'm going to show you why we've constructed this one as dollars. We have options on what we can construct these notes. We can use different currencies. We can do them in rand. We can list them on the JSE. There's all sorts of flexibility of this. We've selected US dollars, and I'm going to show you why as well. And then essentially the whole note is backed by an A-rated global bank. And I'm going to go through the issuers and how we select issuers further in the presentation. So that's essentially what the note does. It closes on the 10th of August. These kinds of investments are not investments that you can, they're not like shares in that you're going to buy and sell them in the secondary market. This is almost like an IPO. We run typically around 4 of these per year. We do promote other third-party product providers as well. We've done a lot of notes with Investec over the years. We really like the Investec notes. We think they're great. But essentially, this is a note that we've kind of prepackaged. And once that product closure date hits, what we call the strike date, you will not be able to buy this product again. You'll have to wait for the next iteration. We're going to fluctuate between doing a growth note like this and then an auto call. So the next presentation will be on an auto call, but this growth note is, it will close. If you haven't subscribed to it, you will not be able to get into this. So it is important, if you do want to invest in this, we need to get the custodian sorted out. We need to put in the applications ahead of time. We always know, we've done many, many notes over the last 7 or 8 years. We know that investors always come to us in the last 2 days and say, yes, I'd like to buy the note. So please don't do that, because I'm going to go through how the custody works. It's much easier if we do the subscription ahead of time. That's essentially what it says on the tin. So now let's just look at how that actually works out from a scenario point of view. I'm going to go through 4 scenarios and how the payoff will work. Now, if you look at this chart in front of us, you can see that there is a blue line. That line is the underlying basket return if you were to just invest directly in the equity market. The orange line is what your payoff is inside the note. And what we're trying to do with these notes and the reason that we create them like this, is we're trying to create a situation in which an investor will outperform if markets are going sideways. It's a more conservative product. It uses, it's essentially credit risk that you're taking on. And if you think anyone who's done economics or that was worked in the financial markets, if you're funding a company, the cheapest way, the most risky way of funding a company is to buy their shares. Then it goes up to their credit, and eventually, you kind of look at that, what do you call it, like the efficient frontier. The higher the risk you are, the higher shares are risky. These kind of sit as medium risk products, because you're taking on essentially bank credit, and the bank is guaranteeing this product. So all the banks are going to be guaranteeing it. But what we're doing here is we're looking at the underlying return profile of the equity markets. But this is not an equity. It is a credit note. So, well, a structured note at least. So what is this going to do? Let's go through the different scenarios of how the payoff profiles work. So scenario 1, I'm just going to flick backwards and forwards between these 2 sides. If the weighted basket, so if that index that we created of S&P 500, Nikkei, and Euro stocks is up by 30%, you would receive your original investment back. So you would get let's say you invested $100,000 in this, you would get your $100,000 back, plus you would get that enhanced return of 30% times 1.9%, 1.9 times. So times the 190%. So your overall return would be, you'd put in $100,000. If the market, that weighted basket was up 30%, you would get $57,000 back. What that's showing you there is that's scenario 1. Like I said, we are trying to create this so that you outperform the general market. That's what the point of this product is, especially if the market is going to go into a more difficult time. We want it to be a conservative product that can, if you're kind of looking at markets and you think, I need to get into cash. We run a stockbroking firm, so what tends to happen is people get nervous of where the market has run to. They sell out of shares and they go back to cash. And what they're doing is they're essentially moving themselves from a high risk investment, because shares are high risk, and they're going straight down to a low risk investment as in cash. So they're completely changing their investment risk profile in one push of the button. What these are doing is they're creating a nice contingent payoff in that kind of medium risk basket. And what we want to do is, if the markets are difficult, we want to use these products as a diversifying factor to someone's equity exposure. And we want to kind of build up a couple of these to if the market doesn't do well over, let's say, the next 5 years, we want this note to do particularly well. So in the situation of scenario 1, if the market was only up, as I said, 30%, so that's where the blue line is, you would only receive 30% if you had bought 3 ETFs based on the underlying basket. If the market's up 30%, you're going to get 30%. In this case, if the market's up 30%, you are going to get 57% return over the period. The second scenario that we're looking at is, what if the weighted basket has fallen by 35%? you would still get back your full investment amount of $100,000, but no additional return as your soft protection is kicked in. So in this case, we're looking over here. We're looking at segment 2. And what's happened there is the market has fallen. And, as I said, this is a more conservative investment than a basket of shares or an ETF. Because if you had gone and just bought that ETF outright and you had said, I want 40% of S&P 500, I'm going to buy a little bit of Europe and a little bit of Japan because I want to be spread across 3 continents in the world, and that basket fell by 35%, you would be down 35%. In this case, you get to look back. You've got insurance inside the product. You've got this capital protection, which brings down your risk profile, and we give all your money back essentially at the end of the year, at the end of the period. What happens there is the blue line might be down 35%, as you can see the underlying return, but you get this enhanced return, and you get all your money back at that stage. So in scenario 2, you outperform, and you can kind of see what this chart is starting to build for you. Anywhere between 40% down and essentially 76% up is your outperformance zone. That's where we're going to do better than this underlying basket. If you just went and bought this underlying basket in the market, you wouldn't get as good a return as this. And you can kind of see where the underperformances come. If we're in scenario 3, which we'll look there, we're just going to be tracking the market. We're going to be doing exactly what the weighted basket would be if you had gone into the equity market and bought a couple of ETFs. On the other hand, the other place that you're going to outperform, if the market is super, super strong, and we do more than 40% on this basket if the underlying basket does more than 40%, and even if it does, let's say 50, 60%, we'll still be in that outperformance zone. But if the market does more than 76%, then it would have been better to have bought the market. Of course, you wouldn't have had the protection if you had done that. And if the market had fallen, and obviously no one can tell what markets are going to do in the short term, you would then have taken that haircut. So those are the kind of like the underperformance zones are when the market is very strong, but you still get 76%, or when the market is very weak, in which case it is the same as buying the market. And I'm going to go through the backtesting now. So if we look at scenario 3, after 5 years, the weighted basket has fallen 45%, you would receive 55,000 of your capital back. So if we look at that, that's this scenario 3 over here. Essentially, the underlying basket fell 45%, and your return is going to be negative 45% over the period. So you must understand that this, while you have that soft protection in place, if it is a real and total collapse, you are going to lose money. Now, a lot of people ask me, because there's a couple of products out there that will give you 100% capital protection. And the reason that we don't go with 100% capital protection is that it's very expensive to do this. If we had to go and get 100% capital protection on an A-rated issuer, your return would be that much lower, because there's nothing for free in life. To get this outperformance in the middle, we've got to sell away some of the, we've got to adopt some of the risks at the tail end. Now, to get that 100% capital protection, it is also spurious. So if a basket of the S&P 500, the 30% Nikkei and 30% Euro stocks is down 80%, no guarantees are in place. It doesn't matter if the capital protection is at 100%. You're talking about an absolute catastrophic event where banks are failing. It's a proper event where we don't believe that the protection that you're buying, that the fee that you're paying for that protection is not real. You're betting on the end of the world, essentially. So that's why we choose not to go with 100% capital protection, and we choose to push that into a better upside return for you. It is possible to tweak that. There are products that do a little bit more, but this specific one is at 40%, and I'm going to show you why it's at 40% in a second. And then, of course, scenario 4 is the last one. So the scenario 3 is in a very weak market. In a very strong market, you can see that we are going to underperform as well, but you will get 76%. So as I said, what happens on the tin is what happens. So if after 5 years, the weighted basket is risen by 100%, you would receive your original investment back 100,000 plus a return of 76,000. So you would make 76% return. As you can see, this is off the side of the chart here, but essentially you will get your 76% on that line over there, even though the market would have done better. The market would have done better. And as I said, what we're trying to create with this product is it's trying to give investors an option that if markets are expensive, if you're concerned about where things are, and you're sitting in a lot of cash, and you want to get into the market, but you don't know if the market is going to kind of go sideways for a while, that's who should be looking at this product. Because what it's going to do is, if you're right in your thesis and the market is slightly down, you're protected. You get all your money back. If the market is slightly up, you get enhanced returns. So if the market only finishes 10% up from here, you beat the market, you get a decent return, it beats your cash return, and you at least get something. You don't miss out if the markets are strong. If you're wrong, however, and the markets pump up higher, at least you're still not sitting in cash. At least you're going to get that 76% return. I'm going to show you why we selected that level as well. And then obviously, if the markets do totally collapse, you do adopt some element of risk there. But like I said, I'm going to show you why we've selected that downside return. So what you're doing is you're taking those two tail events and you're squashing it into the middle, and you're generating yourself extra performance in those two, in a market that hasn't moved a lot, essentially. So that's what the product does. That's what the product does on the tin. Any questions around that at the moment? If you do have questions, you can just hit me in the chat box or the Q&A segment. Okay, it doesn't look like there's any questions. Most people have received the brochure, so I'm assuming you guys knew all of that already. So now we didn't send out the back testing. So this is the back testing, and I'm going to try and explain why we've selected these levels specifically and what you'll achieve with these levels. So the first thing is, why do we want to be in equities? Why do you want to link this product to equities? Why is it not better just to go and stick your money in a bank account and earn some interest, or stick your money in the bond market and like why not just go with other asset classes? What about going for a balanced fund, for example, where you just you have a portion of equity, a portion of bonds, and a portion of cash, and you've achieved your medium risk profile by selecting a balanced fund. Now, for me, I don't think that is the right way of generating medium risk for a client, and this table here will show you why. So this is it's actually based on Investec kind of tweaked it, but it's based on Credit Suisse Global Investment Return Yearbook from 2021. It goes back 120 years of general diversified global equity, bonds, and cash returns. And what you can see over the last 120 years, the nominal growth rate, so the average growth rate in equity markets is around 8.2%, right? So 8.2% is what an average equity market grows at. The bond market grows at about 5%, and cash grows at 3.4%. That's in nominal terms. So that's without inflation. Now, inflation is a little bit all over the place at this stage. So, we're not sure where inflation is. If you guys are looking at what Jerome Powell was saying last night, I mean, it is a bit hairy, but based on historical data, in real terms, so that's an after inflation growth rate, equities delivered 5.3%, bonds delivered only 2.1%, and cash only delivered 0.8%. So you can see when you're looking at the real returns, that's slightly, most of it is being eaten away by inflation if you are sitting in cash or even bonds. And equity markets have had the real return. They've generated real wealth for people over time. So you can see why you want to link to this equity market upside rather than going into a balanced fund where, say, 2/3 of your money are sitting in asset classes that over a long period of time are not going to perform. But of course, you want it to be medium risk still. So that's where this product is kind of suiting people. Now, if you look at that compound return over 120 years, you can see that over a longer period of time, you have to be in equity markets. To sit in cash or to sit in bonds you're going to underperform. But we obviously are cognizant that there are people that cannot afford to take that level of risk. So this is where this product comes in. It tries to link you to the equity markets, but still give you kind of a lower risk profile. Now, why did we select that? Okay, so it's essentially 40% upside with 1.9 times gearing on it to get to that 76% cap. Why were we happy to accept a cap at 76%? Because 76% over 5 years, if you look at that annualized, it's 11.97%. So if you look at the equity market growth, this is all in US dollar terms, it's around 8 to 8.2% nominal growth. You're going to get about just a touch under 12%. So you're talking about almost 1.5 times the average growth is what is expected inside this product. I'm going to go through the probabilities of each scenario playing out. But that's why we're looking at that cap. You lift the cap too much more than that, you end up taking on too much risk. You bring the cap down more than that, and suddenly, yes, you're taking on very little risk, but you're not kind of like matching what the equity market is doing. And that's really what we're trying to achieve, is to give you equity market upside while still giving you the kind of protection that you're going to get in the bond market or in cash. Not quite the same protection, but at least some certainty that if the markets are a bit hairy, you'll still be okay. You'll still get all your money back. On the bottom right here, on the bottom left at least, that's the yellow line is the weighted basket return. And you can see that, and this is just also like the underlying selection, you can see that the Euro stocks has actually been the drag on the overall basket. But both the Nikkei and the S&P 500 have actually done pretty well over the last period. So they're kind of the better ones, and that's kind of what your weighted basket is going to look like on the underside. So now let's look at the back testing. So what does this look like? If we go all the way back and we test like a rolling 5-year period, and we look at like what would the return have been on a rolling 5-year period. And what you've got here is you've got this chart here, which is exactly that, those indices back tested. And you can see it goes all the way back to 2007. So this is data all the way back to about 2002. So from 2002 to 29th of the 6/20, 2007. So just before the financial crisis, your return on that 5-year basket was about 80%, which is where the product is capping. So that's 76-80%. That's where it's going to cap over 5 years. Then what happened is obviously we went into 2008. So now if you had bought in the period just running up into the global financial crisis, you would have gone through a period where markets are really tough. And we wanted to make sure this product would be safe for investors if we were to go through another significant market crash. Now, we have just been through COVID. We've been through a Russia-Ukraine conflict. We've had very choppy bear markets for the last 3 years. You can understand why investors would want protection. Now, looking at this going through, and this is a rolling return going through, the choppy and difficult markets that we've been through recently are not as bad as what happened in 2008. That period was more difficult, if you know what I mean. So if you had invested, let's say, just before 2008, and look forward, let's say you're in 2008, you look forward 5 years. And you were like, okay, let's say you invest in 2007, you look forward 5 years and you get to 2012. That's where you get to 2012 there. You've invested pretty high because the stock market crashed. And what would have happened is if you had bought a basket of equities, if you had just gone into the underlying equity market and said, I want some S&P 500, I want some Euro stocks, I want some Nikkei, what would have happened to your returns? You would have ended down over that 5-year period. You would have been down almost 40%. And that's why the protection is there. So if we look at why I've chosen 40% instead of 30%, you can see the average return. So the average return of the underlying basket over time is around 33%. Okay. Now you're going to get the gearing factor on that. So if the basket returns 33%, remember our upside cap is also 40%. You're going to times that by 1.9. You're going to do great on average. Usually that should happen. The worst moment to invest, since 2002, so over the last 20 years, if you had picked the day that this basket was at the high, just before Lehman Brothers collapsed and the whole world fell apart in 2008, you still would not have breached that 40% downside barrier. 5 years later, you would have been down 39.2%. So you almost would have breached, but you would have gotten all your money back. Now, anyone who went into the market at that stage got hammered. They got absolutely destroyed. You would have been able to get your money back. So you would have invested on the worst possible day. You would have lost, the market would have been down 39%. You would have gotten all your money back. And then you would have been able to make a decision to invest, either in note or in the equity market. And you could potentially redeploy now 40% down, buying the same. Now you go and buy ETFs because you've got that protection in place. And we've got a client with an auto call at the moment, fairly sizable auto call that we put together for them. They did it. He went into this okay, so it's a slightly different structure, but he went into it just before COVID. It was like a couple of days before the COVID and the markets started collapse. It was actually that December. And what's happened is his rolled up return, he's going to get over the period, the market's almost flat. So the market's done kind of like 3%. He's about to be given a 35% dollar-based return over the same period. He can now choose what he wants to do, but there's this enhancement factor with these notes as well. So there you would have gotten all your money back. You could then go and invest in the underlying market. There's no time in the last 20 years that this is breached, including COVID and crashes and everything. This basket has never breached that underlying 40% barrier. That's why we've put the 40% barrier in place. The best return possible was 124%. And like I said, that's the moment that you were in March 2009. So you go, it's that spike right up there. And you go backwards to March 2009. And at the moment the market was at its absolute bottom, you bought into stocks. You would have done 124% point to point over 5 years on this basket. Great return. Unfortunately, if you had bought our basket, you would have been capped. You would have only got your 76%. But the chances of you doing that and the chances of that happening in today's market, I think, are very, very slim, which is why we are offering this note. I'm going to show you the market dynamics in a second. So this is the probabilities of what's going to happen. So this is also based on the back testing. You get capital back you only actually get capital back about 0.5% of the time. And when I say that, most of the time you actually will generate something off this basket. If you look at it, the underlying basket will be 0 to 10% up about 1% of the time. 10 to 30% will be about 1.7% of the time. The underlying basket will be 30 to 50% up 7% of the time, and you will be at the cap. So the chances are you are going to cap this at between 70 and 76%. That's the overwhelming probability of what will happen in this basket. And that is what we expect to happen. So we're expecting that just under 12% US dollar return. There's a 70% chance that is what this product is going to return. So why are we offering this product at this stage? So let's look at the financial market conditions currently. So the first thing is markets are looking a little bit hot in my opinion. You look at something like the Fear and Greed Index. Fear and Greed, it's a wonderful index that you can do. It does the put-call ratio, the volatility index. It's a gauge of sentiment. And you can see that markets over time should swing between fear and greed. Right now, we're in extreme greed. We've seen a huge run up on markets recently. So it's getting quite difficult for me to say to clients, like, let's go and deploy new capital into these markets. Like it's something that you're kind of thinking we want a little bit of a pullback from here. You look at the timeline there, and you can see just over time, you can see how the Fear and Greed Index fluctuates. You can see you're right up there in extreme greed. And over a period, it does tend to oscillate. People get nervous, markets come down. So you do get the sense that right now markets are a little bit expensive. We've had a huge run up in very specific stocks. So AI, supercharged tech bull market they're talking about. You've also had the market's fear gauge hitting the lowest level in 3 years, so volatility has come down. No one is afraid of markets. So if you're thinking back to Warren Buffett, you buy when others are fearful. You be greedy when others are fearful, and you be fearful when others are greedy. There's greed in the market at the moment. And of course, we're not out of the woods yet. The Fed has raised interest rates to the highest level in 22 years. The Fed last night was saying that, no, their base case is that they don't expect a recession. They think the labor market is going to be how can I put it? That isn't going to be a significant impact. They know it's against the historical record, but it looks like they've threaded the needle perfectly and everything is amazing. That, for me, when everyone says everything is going right, that's when you start to get a little bit nervous of where market pricing is. So this chart that I've put up here is the volatility index. It's quite important because I'm sure someone's going to ask me how you create these products. There's no, essentially what the bank is doing is lays off all the risks through option structures underneath it. So essentially they're going to write an out of the money put. That's what gives you back your market participant after 40% down. They're going to buy an at the money call, and they're going to write an at the money call further up. That's kind of the underlying structure that the bank is going to do. You don't need to worry about that because you're not taking on that risk. You're taking on just the promise of the bank, but I'll go through that in a bit. But what happens when these option price, like when you're working with options, generally, if volatility is low, we get much, much better pricing. When volatility is very high, options are very expensive because volatility is one of the inputs into option pricing. So when you can see volatility coming down, it's one of the reasons that we want to offer this type of note now, is because at VIX under 15, the options that we buy are very cheap. It means that the premium that we need to do to create these options is pretty cheap. That gives us the ability to give you much better payoff profiles than if volatility was very, very high. You can think about it in terms of insurance. If you haven't had any break-ins at your house for 20 years and you go to an insurance, say, will you insure my house? They go, well, no break-ins in 20 years. Your premiums are pretty low. If you've just had a break-in and you go to the insurance and be like, oh, sorry, we get broken into all the time. What's my premiums? Your premiums suddenly go up because, the insurers will look at the historical record. And what they're looking at now is they're saying the volatility is low so that the pricing is cheap. So your insurance on this product is very, very cheap, which is why, for me, it's an opportune time to use a product like this. Then you look at where the market is currently, and this is kind of where my concern comes around, just going, buying straight into the equity market. I mean, we run we run offshore funds, we run seg portfolio mandates, global equity portfolios, ETF portfolios. We've got an AI portfolio we've just launched. We like the story. We like equity markets. But if you look at the timing, and I mean, we generally do phased implementations on our equity products. So we normally would look at this and say, hey, it's a little bit expensive. Let's wait for it to come back. Then we'll buy in. It's one of the luxuries of being able to work with clients and seg mandates. We don't have to just bash your money into the market. But if you're looking to deploy capital now, this is where this is just the S&P 500 ETF. You can see kind of where this, that I've just drawn a channel in there. For me, we're right up at the top of the channel. I've got an RSI on here as well. You can see also looking very, very overbought. We've had a spectacular recovery in 2023. So how do you play it from here? If you've got new capital deployed, you just sit on the sidelines and say, I'm not getting involved in equity markets. You can't really do that long term. If you do that long term, what happens if the market goes up another 10%? What happens if it goes up another 20, 30, 40% and you're still in cash? Suddenly that inflation, we've got high inflation at the moment. Your money is being eroded. Remember those real returns versus nominal returns. You need to be linked to equities. But how do you link to equities? Here I'm saying putting a little bit of capital protection as well is probably a good idea. So I've also just included this side. One of the problems with the market at the moment, and one of the problems that the indices have run up as they have, it's kind of created this great stock pickers market, but it's not that good for index investors, which is why I'd probably put capital protection on it. Of the move up, you can see the market breadth has been incredibly narrow. So if you look at it, the biggest, okay, so this is a slightly older slide, but the biggest move has come from the big tech companies in the US. S&P 500 has moved up because of Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla. Those have been the big movers up. And it is a little bit of an older slide, but you haven't had the rest of the market kind of playing catch up. Now, everyone is kind of asking, like, are we going to get like a rotation out of these big tech names? Are the tech names going to come down and some of those cheaper stocks going to be bought? In which case your index is going to do nothing. Are the tech names going to stay up and then money's just going to pump in and pump up the rest, the other 193 in the S&P 500, which have only delivered 3.6%? Are all of those stocks suddenly going to be bid up and then the index is going to go berserk? I don't know. It's difficult to see how that's going to happen. This has been a very speculative bubble, largely around the excitement around a new technology, which is AI. So it's uncertain, is all I'm saying. And having a product like this is maybe something that will be decent longer term. I think you might do better than just going and buying stocks directly. It's incredible to think, though, that after the difficult years that we've had, we're only 4.8% off highs. The market is only 4.8% away from record highs. So we've had a strong run up. And I don't know if all the problems have been solved on the ground. It does seem pretty rosy out there at the moment, but again, maybe time for a little bit of protection. The next thing is we've selected this obviously as a US dollar-based product. Looking at the US dollar at the moment, okay, today I picked up this chart at 17.56. We got as low as 17.45. That's down from almost 20. Now, why do we want obviously a US dollar base? This is a demand that's largely coming from our client base. Clients want to be invested offshore. When we speak to clients and we offer them local options, they go, oh, can't you get me something offshore? Can't you get me something in dollars or pounds or euros? That's what people are looking for. This, for me, looks like, again, an opportune moment to convert rand to dollar. Another reason that we like this product at the moment. You can see at 20, we would probably have held off and said, no, let's rather look at a local product. Let's look at something that isn't linked to dollars. Let's go and look at the local market, something else. But with the big recovery that we've seen in specifically the rand dollar rate, for me now is a good time to exchange rands for something that has a dollar base or something that is in the international markets. You have the timing right on this as well, in my opinion. Timing is always a very, very difficult thing, and the currency might get a lot stronger. We might go to 1650. It is one of the risks around the product that this is an offshore product, so you are going to have exposure to currency. You're going to have dollar-based exposure. There are tax advantages to that. Obviously that you get to choose between the $2 rates, and that allows you to be a little bit more flexible. You're also not paying tax on inflation. So there are benefits to being invested in dollars, which is more of a general discussion. But for me, I think this looks like an opportune time to buy an offshore product. So now let's look at so you kind of understood the payoff profile. You've understood what it's done historically. You've understood, hopefully, why we've selected it this time, why we've created the product as we have. So now let's look at the structure, the fees, and the risks around the product. So the structure of the product, okay, just to start with, there's a couple of different parties when it comes to products like this. So the first is the advisor. So we sit as the advisor to this product. So we have created this product. We have other advisors that we work with as well in order to kind of get our pricing right. So I farm this out to a whole lot of issuers. With structured products, I like to have like 3 or 4 people that I can chat to. I can say, I want to buy this product, and this is and I just tell them, solve for participation, solve for fees, solve for whatever I want. We kind of solve the equation to try and get the exact payoff profile that we're looking at, and then we build the product. So we say we want 30%, 40% capital protection. We want that. That's what Rand Swiss is doing, right? So that's it. You aren't taking any risk on Rand Swiss. If Rand Swiss disappears tomorrow, there's no problem with that. So that's what Rand Swiss does. I'll go through that in a second. Then you've got the issuer. The issuer is the bank that is actually, you are taking the risk on that bank. We only use A-rated banks. Now, I'm going to show you an example of a non-A-rated entity and what that does to your payoff profile. It's pretty spectacular. But for here, you think about it in terms of the risk of the issuer. You think about it, South Africans are normally pretty aware of the credit ratings agencies ever since the downgrade. South Africa is not an A-rated sovereign. These are A-rated banks. Their credit rating is better than South Africa's credit rating. So essentially, if you look at the issuers, they are the ones making the promise to create that contingent payoff profile. Now, a lot of people say to us, but you're betting against the bank. If the bank is going to give me this payoff, it means that they're winning somehow. They are winning. Like I said, they don't care. They really couldn't care less which direction you're buying. They're immediately taking in your money, and they're immediately laying off the underlying options and hedging all that risk. What they want is to take in that deposit onto their balance sheet, and they want to then hedge that risk, and inside that is a fee. I'm going to go through the fees that each charge. The issuer charges all their fees within the product. It comes out in the pricing, which is why I price against 8 or 9 or 10 different international banks to see who's got the sharpest pricing. I'm going to take you through a quote in a second. And then the third entity involved in these structured products is your custodian. Where is your money? Where is your money sitting? It's not sitting on my balance sheet. It's not sitting on Rand Swiss's balance sheet. It's not sitting here. We are the advisor and the creator of the product. We are the one that's putting all of this together. We're fee clearing you. You're doing all of that. The issuer is the one that's making the promise, but the custodian is who's holding your money. It's the platform that the money is sitting on. We have 3 platforms that we use: Swissquote, DMA, and Velocity for custody. That is not an exhaustive list. If you have an offshore custodian, speak to us. We can often there's an ISIN number on every note that's created. We can often just send it to your account overseas. You don't have to use one of our custodians. We have done a lot of work in the South African market to make custody cheap and accessible for clients. When we started doing this 8 years ago, it was very, very difficult to get custody sorted out for clients. You were kind of limited to the big bank issuers and creators of structured products. We have done an incredible amount of work with the platforms, agitating to try and get them to custody these products. I'm so happy to report that we can now custody at Swissquote, DMA, and Velocity, which are 3 preferred underlying stockbroking solutions. We can also put these in wrappers. So Global Life Plan from Sanlam, Momentum Wealth International Endowment, also possible. And you can use those life wrappers with the product inside a life wrapper as well. But that's essentially the three parties that we're talking about right now. I'm going to run through each in turn. Who is Rand Swiss? I know I've got a lot of new people on the call as well. Rand Swiss, we are currently ranked the #1 securities broker in South Africa. We sit in the JSE building. I'm sitting in the JSE building right now. We've been ranked #1 3 out of the last 4 years. We've won all sorts of awards: top stockbroker, top self-service broker, People's Choice Award, a whole lot of things. Like we're fairly well recognized in the industry. But as I said, you're not taking on any credit risk of Rand Swiss. We work with a lot of partners that we lay that off, and how much are we charging for this, which is another important question. But where does that sit within our business? Our business is broken into securities broking, managed solutions, and wealth and advisory. As you can see, we've highlighted this. This sits within our managed solutions. So this sits alongside our equity portfolios that are model portfolios. These are medium risk options. Like I said, we prefer them to like a traditional balanced fund, just because a balanced fund, you're getting exposure to all these things that you don't actually want longer term. And then you're just sitting there with only a portion of your money generating big returns when you could have all of it generating, good returns, but at a medium risk profile. So that's where our structured products sit within our business. This is one specifically called Global Growth Note. Now we've built in a 4% fee over the full 5-year term. So what does that mean? That means we are charging, and the same as the issuer, our fee is inside the product. So when we say, you're going to get 1.9 times gearing and you're going to get 40% capital protection. If you put in $100,000, our fee is inside that price. But we're disclosing the fee. It's 4% over the whole term, which, as you can see, it's lower than an active management fee. If you went into an active portfolio, you would pay more than that. Most active managers are at 1.25. If you look at total expense ratios, if you're going to sit on a list with everything wrapped around it and your advisor and everything, you can be at 2-3%. We're charging 0.79% per year, essentially, for the duration of the structure. It's structured as a 4% fee because we want to show you the whole fee that is charged over the period of the product, because it's a 4-year term product. At the same time, the fee is compressed for the term if we can't get the issue. So remember, we're doing a book build at the moment where we're speaking to a lot of investors, we get all the money in, and then on the 10th of August, we go to the market and we strike. Now, right now, as I said, I did the pricing on the product at the moment. It's actually sitting at about call it 2 times 2, maybe 210%. So that's not going to give you a cap of 76%. It's actually going to be high. If we get it through at, let's say, 2, you're actually going to be sitting at an 80% upside cap. So it actually improves the return. We put this fee in at 4% because we say we will never take more than 4% inside the product. If we get better terms from the issuer, if we get an issuer that just says, actually, you can have 2.3 times upside and your cap is going to go up accordingly, we will cap at 4%. We will not suddenly go, well, you still get your 1.9 times and we'll take an 8% fee, which is very prevalent in the structured product market. We do not do that. We give you clean pricing on this stuff, and any benefit that we get on the day of strike, we just push straight through to the client. The other reason the fee is there as well is, we go through this whole effort. We do webinars, we build brochures, we do all the back testing and the research, and we kind of build this thesis. And then we come on the day, we will not strike if the terms are worse than what we've advertised. So if we go on the day and we suddenly price, and the thing is pricing at exactly 1.9 times upside at 40% capital protection on these terms, we'll look at it and go, or let's say pricing at 1.89 times upside. What we'll do is we'll chop our fee. We'll just take our fee right down so that we make sure that the product goes through. So the fee also builds in a little bit of fat that we can then compress the fee if we just want to get the issue through. So that's kind of our fee. It'll never be worse than that. And it is pretty reasonable considering the work we do, I'll be honest. It's got a lot of work to do these things. Then let's look, okay, so you've looked at the advisor, which is us, then you look at the issuers. So the issuers, these are issuers. So this is actually off the system. And I just wanted to give you an idea of the difference between issuer risk as well. So these are minimum notional amounts that the issuers will take. Remember, we are doing this at $20,000 per clip. So $20,000 is what we'll take in from a client. we can potentially squeeze that a little bit lower because we're taking all of your flow and we're taking all of the applications, we're lumping them together. It still sits in your underlying custody account, but we then going to the issuers and saying, we've got $500,000, we've got $1 million, we've got $5 million, and we're haggling with them on pricing based on everyone's pricing, which is why there's no way that you can do this. I mean, you can do this on your own, but even if you had $1 million to go and negotiate with the issuer, it would still be better to do it with us, because I can guarantee you we've built long-term relationships with these guys over the last 8 years. When we go for pricing and when you go for pricing, it'll be very, very different pricing, because we're buying wholesale. You unfortunately are buying retail. So we club all our flow together and we go and then farm it out to these issuers. So these are just some examples. This isn't an exhaustive list, but I would literally go and tick all these boxes. I'll go and send it to all the issuers on an online system, and they'll all quote. And it takes about 24 hours. They come back to me, and Citibank will come back with this price. Credit Suisse might come back with that price. Goldman Sachs will come back at this price. And each one will give me a different thing. You can see all the credit ratings over there. And basically, you know, like I said, we will only ever take an A-rated bank. Right now, given the history, I know UBS has now taken over Credit Suisse. We wouldn't take Credit Suisse as paper right now anyway, but we don't know who's going to come in at the best. So we kind of look at the return now. We price as where is the market sitting, but you could get BNP Paribas credit, you might get Barclays credit, you might get JP Morgan credit. It'll be one of those, and it'll never be worse than an A-rated issuer. But it just gives you an idea. Now, on the right-hand side, we've also got direct lines with Marex. Now, Marex is a big international structuring house and derivative broker. They aren't an A-rated issuer. So I just wanted to give you this as a comparison. Now, we wouldn't give you Marex. On your term sheet and your confirmation will be which issuer, and we give you a whole note on what issuer. Everything gets an ISIN number. You can go on a Bloomberg terminal or a Reuters terminal. You can plug in the ISIN. You can pull up and see your money there. You know, depending on the custodian you use, you're going to be able to log in and see a line item on in your account with your active pricing and all of that. But I just wanted to give you an example of an issuer that isn't an A-rated issuer and what it does to the participation. So I had this priced today from Marex, and you can see this is like if you would like to take more speculative paper. And I'm sure there are clients out there that would look at this and say, Gary, I like the 1.9% upside, but if I take slightly higher credit risk, so if I take a slightly weaker bank making the promise, I can get 290% participation. And this is where a lot of the nonsense happens in structured products. Guys offer lower rated banks, so they give you worse paper. And then what they do is they take large fees. Like I said, our fees are transparent. We cap our fees. But what they do is you can see the difference in participation. Now, these are very, very easy to make. So if you are interested in doing a separate note for this, we do these bespoke for clients as well. If you want to get 2.9 times upside, so you know, literally almost 3 times your money. I mean, the cap will still be at 40%. So you can see the cap is still at 40%. The protection is still at 40%. The basket remains the same. The term remains the same. It's still a US dollar product, but you're almost getting a 3 times return. That means that you'll get about 120% upside by taking a slightly worse issuer. Why don't we do that and give everyone amazing returns? We could, and if there was a huge speculative demand for it, we might push into a weaker issuer. But really what we want these as medium risk products. They complement our equity strategies. So we can get speculative on them, but we prefer the A-rated paper. We want guys like, you know, we've issued against SocGen, Morgan Stanley, and Citi, and BNP Paribas, and Barclays before. We don't generally go with, and JP Morgan. We don't generally go with Goldman Sachs. We don't go with Credit Suisse. But all of those banks are systemically important in the areas that they operate in. We are very comfortable to take on the promises that they make to us. And that's why we select those underlying banks. But again, just wanted to give you an example of if you tweak your credit risk slightly, solve the same equation with a slightly weaker issuer, just how much more upside you can get. So hopefully that find you interesting. So okay, so the third party here, remember there's us as the advisor, there's then the issuer, which is the bank making the promise and saying, I'll give you the capital protection, I'll give you the upside return. You then get the custodian. Like I said, these are the 3 custodians we work with. There are more custodians that can hold this. If you want to use a specific custodian and you don't want to use one of our custodians, we are absolutely fine with that. We'll still split the trade. We'll arrange the whole thing with you. You just have to check with whether your custodian is on our list or not. You just get hold of us and we can tell you. But these accounts, I just want to give you an indicative pricing on the underlying custody. This doesn't sit within. So the Rand Swiss fee and the issuer fees all sit within the product. This sits outside the product, right? So it's kind of what you would expect to pay on an international platform. So your custody at Velocity Trade is going to be 10 basis points per annum. So that's basically what you'll pay annually. And then your execution fee is going to be 0.15%. So if you think about it like you're buying a stock on the JSE, brokerage sits between 0.2% and 0.5%. You can think of these credit notes almost as stocks that you're buying inside your portfolio. You can buy them alongside your existing. You can have Anglo and Billiton and Apple and Google in your portfolio, and you can have one of these credit notes sitting in your portfolio. You will pay the custody fee at 0.10, and your execution fee is low. We've squeezed them as hard as we can on these execution fees. So you're going in at 15 basis points on execution. Velocity require a minimum of 20,000. So like I said, we can squeeze our minimum. We've made the minimum on this product 20,000 just to make it nice and simple. But Velocity will require a $20,000 deposit in order to do this product. DMA, the pricing slightly different. Their custody is a little bit more expensive at 15 basis points on structures. The execution is a little bit cheaper. So the execution is at 10. They will also take smaller accounts. So they will take issues up to 10,000, which, like I said, if you want to do 10,000 into the product, we will make an arrangement for you. We like to try and keep it at the headline ticket size, but if you're at DMA, we can go a little bit lower. Swissquote. So Swissquote also, like the actual minimum on the product, we can go lower, but we don't suggest actually using Swissquote as a custodian unless you're going to put in at least $40,000. Swissquote is an incredible bank. Your online fully Swiss bank account, you can get credit cards on it. It is a little bit more expensive, so your execution is at 40 basis points. The underlying custody is at 15 basis points. And your custody, your minimum custody on the account is going to be 60 francs per year. So that's where that 40,000 number comes from. If you've got $40,000 in the account, you don't have to do all the 40,000 into one structured product. You can go buy Apple and Google and some offshore funds or whatever you want to do in the account. But we suggest having a minimum at Swissquote of at least 40,000 just to make that 60 franc per year fee, minimum fee viable. So that's kind of where those levels are. Those are the custodians that we'll help you set up with. If you don't have a custodian that we can use, we need to set these up. Swissquote takes a little bit of time. They need to have wet signatures on documents. We've got to courier the stuff to Switzerland. It's really cool because you're going to get a Swiss bank account with all the bells and whistles of a Swiss bank account, which is very, very cool. But like I said, it takes a little bit of time to set up for South African citizens. So we'd rather do that. If you are looking at a Swiss option, I would say get hold of us literally tomorrow and say, we want to set that up because it'll take probably about a week for us to rush it through. If we're going to custody at Swissquote. DMA, that's probably about a 4 to 5 day process, depending if it's a person or a trust or a company or however you're doing it. Velocity Trade, quick and easy. We can have those accounts open in under 24 hours. So that's kind of like just the turnaround times. If you're thinking of telling us that you'd like to come in on the 9th of August, it's pretty much Velocity Trade is going to be your only option, and we're going to have to like scramble to make it happen. So then what are the important risks and dates? I'll just start with the dates. 10th of August is the date that we have to have applications and we have to have everything sorted out by the 10th of August. From there, we reserve 30 days to actually strike the product. So it could be up to a month later that we actually do the underlying strike and set the levels. And again, if we go in and on the 11th of August or the 15th of August, we have our pricing and we can give you a nice kicker, we will strike. We don't want to take the risk that something happens in the press overseas or, I don't know, China invades Taiwan or something crazy happens and suddenly volatility spikes and everything falls apart. We don't want someone to go and rob a house and then they have to go and try and buy insurance, So if we've got the pricing, we're going to put it through quickly, but we do just try and obviously get you guys the best levels as well. So we give about 30 days to do strike. Once we strike, we'll publish exactly where the underlying indices were. So where was the Nikkei, where was the Euro stocks, where was the S&P 500? That becomes your base calculation. And from that weighted basket, we then calculate your return at the end. The maturity date is set 5 years forward. From there, and then when it expires, we can return capital to your accounts. This is a fully offshore product, so your money never has to come back to South Africa. Just two other important points. We can hold these in, we've done them for international trusts and local trusts, no problem with that. Local trusts obviously don't have offshore allowances, so we have to arrange an asset swap for you as well. Asset swap will cost around 35 basis points, depending on the size of trade. If you're going to do a huge trade, we can squeeze that down probably to about 10 basis points, but you're talking at least more than $10 million. Otherwise, you'll face about 0.35% for a local trust or a local company that wants to invest in these, but no problem on entities. Trusts, companies, just let's get the application paperwork in if we're going to do the custody for you. Private citizens, no problem. Tax wrappers, also not a problem. If you want to use a life wrapper, we can use a life wrapper. You can take it in there. So that's who can invest. The risks, okay, the investment is obviously in US dollars, so you do face currency risk. That can work in your favor, it can work against you. If the, like I said in that chart, the rand is pretty strong, in my opinion, at the moment. Looks like a good time. If the rand blows out in rand terms, obviously you're going to get more back in rand terms because you're going to get the full dollar price movement as well. If the rand strengthens further, that will detract from your performance because you're going to buy dollars, we're going to move dollars out, you're going to buy the product in dollars, and we're going to return dollars to you at the end of it for you either to go and buy international stocks, bring it back to rand, do whatever you like. There is a risk of capital loss. Now, it is quite important. So the other reason that we prefer not to have 100% capital protection within these notes is, again, I'm not going to give you the tax ruling around this, but largely people claim CGT on these products, one, because they're over 3.5 years, and two, because you have capital at risk. It's an uncertain payoff profile. So it does, a structured note should attract CGT from what we understand, but obviously you want to run that past a tax practitioner as well. I've never heard, and we've done these notes for a long time, I've never heard of anyone being hit with income tax on these products. But obviously, if you want a tax opinion, we can put you in touch with our tax practitioners and tax advisors. Of course, if you're putting it inside a wrapper, the wrapper is going to pay the tax for you. They pay at that reduced CGT rate. They pay CGT on inside the wrapper. There, you don't have to do it. If you've got a trust we've done them for trusts in Guernsey and Mauritius, there you're owning an international product and that is essentially an international entity owning an international product, then there is no tax on it, which is great. And I think it's important to understand that a lot of these products are wrapped up in all sorts of layers. I mean, guys put these products inside endowments and sell the whole endowment wrapper. They sell, like they'll structure it as companies. There's all sorts of different ways of structuring a structured product, of creating a structured product. It's always been the philosophy. I mean, I think it comes from my securities broking background. I want to get you as close to the value generating asset as possible. I try and strip off all the layers around it, all the fluff that you don't need, so that you can get the core thing that is actually generating you value. Then you can decide, what do you want? If you're sitting inside a trust, why are you then, I mean, I've seen a lot of guys structure these that you do it in an endowment. So there's a note in an endowment, but you buy it like off the shelf like that. Now, if you're sitting in an international trust, why are you buying it inside an endowment? I mean, local trust, I can understand if it's all got natural people and, maybe you can get, it's a local trust, so it's quite a punitive tax structure. But if you're in a tax haven, man, why are you not just buying the underlying asset? That's what we're offering you here, the underlying asset. But there is a risk of obviously capital loss. If the market is down 70%, you are going to be down 70% if the basket is down 70%. So risk of no investment return if the weighted basket closes below the initial level at maturity late. Yeah, so that when I say no investment return, as in you'll get your capital back. Don't expect there to be an interest rate attached to it. If the basket is down 10% over the period, you're not going to get interest on your capital. You will get your money back, but it's just going to be, if you invested $100,000, you're going to get $100,000 back minus your custody fees and your execution fee. That's from whichever platform you're using. Those are platform fees that you're going to pay. There's a risk of obviously total loss of partial in the case of bankruptcy and the payment. And this is what this comes down to, issuer risk. There is a risk on the issuer. Like I said, we choose A-rated issuers. If Citibank goes out of business, we have bigger problems in the world. But if Citibank goes out of business, their share price has to go to zero, and then you will take some sort of potential haircut on this. So just remember, like, think of Steinhoff as an example. We've had Steinhoff in the news because they're delisting the shares at the moment. The creditors to Steinhoff, so the people that held Steinhoff credit, are still going to get paid. They've given a debt holiday. They've still got access to all those Steinhoff assets. Shareholders have been wiped out. in order for you to take capital risk, Citibank's share price, Citigroup has to go bang. BNP Paribas has to be, basically their equity has to be written to zero, and then you might take a knock on this product. So there's that issuer risk, but it's the reason that we take these A-rated banks. We want these to be medium risk products. We want them to be safer than shares. We want them to be safer than investing in ordinary shares, and that's essentially why we choose the high level issuer. If you want to go for like super speculative paper, that's also cool. We can go and get you some really speculative paper and give you massive returns on these things. But it's not what this product is doing. This product is designed to be safe, but there is obviously the risk that if the issuer defaults for whatever reason, you might take some sort of haircut on the product. You might not get your full capital back. But as I said, I've been watching these for a long time. The chances of this happening are very low, but it's important to understand. If you need access to your funds before the end of the term, the terms and conditions might not apply. So remember, what's happening here is basically this option structure underneath there. The capital guarantee is at the maturity of the product. So the product does have pricing that moves around during the period, but if you wait for 5 years, it will do exactly what it says on the tin. You will get the upside, you'll get the downside. The kind of risk is that if you come to us a year in and say, well, now I need to sell. Remember, options, the way that the options are created is we're buying the option, the call option, and we're spending premium to get that option. Now, we need to wait for that option to expire to get the value. If that option's in the money, that's where as the theta decays, that's where the value is created. So often you'll see that, like, as the products expire, you suddenly get this huge mark-to-market fair value boosts in the last year. And that you don't need to, you shouldn't worry as you go along. But if you want to get out early, there could potentially be a capital haircut. So I generally like to say to clients that there is no liquidity on these structures. If you're going in for 5 years, you must be in for 5 years. We can actually, the underlying issuers do offer us liquidity, and we can do it kind of on a willing buyer, willing seller basis. So if we can find someone that would like to buy the issuer, and genuinely we can, because our clients like these kinds of products. So if you do want to get out early, we will make you a price on it, and we will find a buyer, hopefully within our client base or outside of our client base, that will pick up your script. So there isn't zero liquidity, but we like to just make that risk, you're aware of that risk. We don't guarantee liquidity on these products. So, if you're going into this, think that you're in for 5 years. Don't come 3 years in and say, I'd like my money back. We'll do what we can to help you, but look at this as a 5-year investment. It should be a 5-year locked-in investment. Okay, and then getting started is not particularly difficult. So onboarding, we obviously need your normal KYC. We will send around the presentation. So here's a list for trusts, companies, and individuals, foreign and local, of exactly what KYC documents we require and what will suit. So we need your KYC. We need you to do a mandate, obviously, so the terms and conditions on an account with Rand Swiss. You need to choose your custodian. If you already have a custodian, that's fine. You just tell us who we are. As long as we can send the paper there, there's no problem. We don't need to set up with one of our custodians. If you do want to, we can take you through. By all means, just contact us. You've got our contact details on the page there. Just get hold of us. Tell us which custodian you want to do. If you need advice around which custodian is better, we will guide you through that. We can take in dollars. So if you've got dollars already that are sitting overseas and you want to buy with dollars, we can take dollar inflows, no problem. You literally send the dollars to your custodian. We send the trade to the custodian. The trade happens and it lands in your account. And so but if you're in Rand, like I said, what we normally do is we'll do the FX for you. So we'll create it's generally an invested bank account. We'll take in your Rand deposit. We'll do the transaction for you as a benefit. You get very, very low FX conversion fees with us, far lower than you'll get elsewhere in the market. And that's because we know you're going into this product. So we will squeeze the rates for you because we want you to get as much as you can. And we're happy with our distributor fee, at least with our advisor fee. We're not here to profiteer off you and try and make all the money. So we'll do a Forex transaction at a very low cost. It just also makes it easier because we're sending it to the right custodian. And for you, it's literally as easy as I'm just going to do a local EFT to an investor bank account in your name. We take care of all the rest of the business underneath it. And you don't have to suddenly be sending money to issuers and all sorts of, to custodians at least. And then the last thing is you just tell us, once you've signed a mandate and we've got you on board as a client, it's literally an instruction. We can take it even on a recorded phone call, but you send us an instruction and we just confirm in writing, I want to do $20,000 in the bros. I want to do $100,000 into the product. We take your subscription on the 10th of August, we strike, and within 30 days, 30 days plus settlement, it usually falls into your account. And then you sit back and you enjoy it and you're invested. So that's it. Thank you very much for listening. I was exactly an hour. So if there are any questions, please do let me know. Yes, no questions. So hopefully I explained everything very well. I will thank you very much. If there are any questions, please also feel free to pop it to us on email. Best of luck out there. The markets are fun. I will see you soon.